Today we're going to talk about 5 cognitive biases, aka irrational behaviors, that I have seen ruin retirements over my 25 years as a financial advisor. It happens more than you might think. I have met with over 300 wealthy families. That empirical data set is what I draw upon for the information that I'm about to share with you. Over 20 years ago, I became interested in behavioral finance through the CFA program. And since that time, I have studied extensively all of the work by Kahneman, Tversky, Thaler, Statman, and others. I'm not a trained psychologist, but I do have a lot of practical experience and observation in this very narrow channel of psychology. The 5 investor biases that can ruin retirements are overconfidence, herd behavior, anchoring, money illusion, and loss aversion. I'm going to talk about these biases in simple terms that anyone can understand so you can easily see how they can wreck your retirement. Let's go. We'll start with overconfidence, which is timely because I think there is a lot of overconfidence today, December 2024. Overconfidence is a simple way of saying you don't know your limitations. The last time that I saw a lot of overconfidence was the late 1990s, after an 18-year unabated bull market. Everybody thought they were smart, but were they lucky or smart? That's something you need to ask yourself. Overconfidence, in my opinion, leads to excess risk-taking because people don't have an appreciation for how volatile investments can become. They become overly confident in their decisions to concentrate in stocks like the Magnificent Seven or over-allocate their portfolio to growth. Over the years, over recent years anyways, the last 16 to be exact, they've made a ton of money. So people have too much confidence in their ability to manage their funds or what growth funds will do for them, and then the market cycle reverses. Everything changes. That overconfidence vanishes quickly, like it did in the early 2000s, but when it happens fast. And for the person who's overly confident in their abilities in their portfolio, they lose a lot of money. Let's take a look at a visual illustration where overconfidence presents the greatest issue. There's a tendency for investors to become overly confident towards the end of bull markets. The green arrows on this graph of the S&P 500 are bull markets. In the late 1990s, overconfidence was a real problem. The overconfidence that I observed in the late 1990s was shocking. In many cases, I met with people who were retired or about to retire, and they had no clue how much risk they were taking in their portfolio. And that is because they were in their 40s when the bull market started. They had been investing for well over a decade and making money the entire time. Often, they were in very aggressive growth and technology funds, and they had no comprehension of just how aggressive the portfolio was or how volatile the portfolio could become if we were to get a prolonged downturn. Before the bubble burst, it was very difficult to educate investors about the amount of risk that they were taking. And they didn't want to hear it. They didn't believe you. They were so confident that they were going to keep making money like they had been for the last decade plus, trend extrapolation. But then the bubble did burst. When the market started crashing in 2000, those who were overly confident just said, buy the dip. It's great. It's the best opportunity. It's going to come back. But then the market started going lower and lower and lower for the next several years. And those who were overly confident, overly aggressive in their portfolios, and didn't know their limitations, they freaked out. They didn't know what to do. They're like, oh my goodness, the sky's falling. And unfortunately, for many of them, circa 2003, they sold out at the bottom. They finally gave in and said enough is enough and completely ruined their retirements. Here's what that 2000 crash looked like up close. This is where a lot of people capitulated. 2003, they threw in the towel, unfortunately. They got really scared once we got down to this price level and they threw in the towel. And for those who were overconfident, it cost them a tremendous amount of money because the market then went up and up and up, and they had to buy back in at higher prices if they even got back in. Well, here we are in late 2024, and everybody is a genius again. It's been 16 years of an incredible bull market. The risk taking is off the charts. In my opinion, it's far worse than 2000. It's unlike anything I've ever seen. When you consider the concentration in the Magnificent Seven, for example, it's nuts. Worse than 1929, worse than 2000, by far. Don't let overconfidence ruin your retirement. Now you might be thinking, oh, only stupid people would act this way. Au contraire. I've seen so many brilliant people succumb to overconfidence. It's incredible. Cardiologists, surgeons, lawyers, engineers, business owners, you name it. I've seen so many people, met so many people, reviewed their portfolios, seen their losses. It's incredible how people can succumb to overconfidence and then blow themselves up. Don't let it happen to you. Now let's talk about herd behavior. Herd behavior is another dangerous heuristic or cognitive bias that can ruin your retirement. It can cost you millions of dollars. Herd behavior is very simple. You end up doing what everyone else is doing. Usually this happens at market tops and market bottoms. And you end up doing what everyone else is doing because the mental shortcut of just following everyone else is easier than standing alone. It's very difficult to stand on your own 2 feet when everyone else is going left and you have to go right. What if you're wrong? Most people can't handle that kind of pressure, and they end up doing what their neighbors are doing and their friends at the country club or their colleagues in the OR, etc., etc. Don't let herd behavior govern your financial decisions. A recent example of herd behavior was the spring of 2020. There were a lot of people, really smart people, who panicked and sold their portfolios when the market dropped. Most of them right about at the bottom in March. And these were people who abandoned their financial plan, their asset allocation, their retirement planning, everything. Throw it out the window. I'm terrified. The world's coming to an end. I'm going to do what everyone else is doing. I'm just going to sell out. By the way, I saw the same thing happen in 2008, late 2008, early 2009. It will happen again. So you need to make sure that you know what herd behavior is. I mean, it's pretty simple, right? But just don't let it happen to you. Be strong enough to not succumb to the urge to do what everyone else is doing. Anchoring, also known as reference point dependency. This is another dangerous heuristic and bias that can cost you millions and ruin your retirement. Here's an example of anchoring. You have $3 million of concentrated employer stock. You want to sell the stock, but then it starts going down. And now it's at $2,500,000. And you say something like, I have to wait for it to go back to $3 million before I can do anything. That is a textbook example of anchoring. I've seen it many times. I've watched people get wiped out because of anchoring, lose millions of dollars. Recently, I met someone who had a lot of money, millions and millions of dollars in a telecom stock. I won't say which one. They have gotten turned upside down because they refused to sell back in 2021, and they have ridden the telecom stock lower and lower and lower. And unfortunately for this person, the telecom stock is in an option, and the life of that option is just about to expire. They're going to lose everything. Don't let anchoring ruin your retirement. If you find yourself making statements like, I want to rebalance my portfolio, but only when the value gets back up to X, or I want to reduce my concentration in my employer stock, but only when the price goes back up to Y. You are dealing with anchoring and you don't know it. And what can happen, as it often does, the stock doesn't know you. It doesn't care about you, and it just keeps going down lower and lower and lower. And before you know it, you're toast. Make an objective, rational decision about dealing with concentrated securities and portfolio values where you need to have some rebalancing. Don't let anchoring affect your decision making to the point that you lose a lot of money. If your financial advisor is not well versed in behavioral finance and how it affects your wealth, please give my office a call. We would be happy to give you a second opinion on your retirement plan. Money illusion is our fourth investor bias, and it can cost you big in retirement. Money illusion refers to only focusing on what you can see and ignoring what you can't see. Here's a perfect example of money illusion. Investing in variable annuities that have lifetime income riders and cost you, 3.75% per year in fees that are hidden from you. You think you're making money in the contract because you put $100,000 in and it goes up to 103 or 104. But what about all the fees that are eating you up over time and giving you a tremendous loss in terms of opportunity cost? That is money illusion. The classic example of money illusion is inflation. Let's say you're earning 2.5% in a fixed annuity and inflation is 3.5%. You are losing money in purchasing power terms, but because you see your account value going up over time, you think you're making money and you are not connecting the dots between nominal returns and real returns. In other words, I can't see the inflation, so it doesn't exist. In my opinion, it's the same with hidden fees. If I can't see them, they must not be there. Ironically, I see this the most with the most sophisticated investors who invest their money in hedge funds, private equity, private real estate deals, things like that. They're paying outrageous fees, but they don't see them. They're hidden from them. And the GPs will say, oh, look, I got you this return. You put in $100,000, you got 150. But the GP never says, well, if you would have just bought the S&P 500, you would have got 200, right? It's amazing how money illusion affects people. And again, in particular with private investments, most people that invest in private investments, for whatever reason, don't realize they would have been better off just buying the S&P 500. Warren Buffett talks about this all the time. He has for many years, that private investments just don't do that well in aggregate, and it's because of the outrageous fees. Great example of money illusion, my opinion. The bottom line is that money illusion can cost you a lot of money over time due to inflation or opportunity cost. The final investor bias that we're going to discuss is loss aversion. Loss aversion is the tendency for someone to fixate on losses in the portfolio and ignore all the gains. They feel losses at a rate double how they feel gains. Losses are very painful. Let me give you an example. Let's say that you open an investment account with $1 million and a few years later the account is at 1.3 million. Most people would look at the value and say, wow, I'm up $300,000. But a person who is suffering from loss aversion will look at any position in that portfolio that happens to be down and they will just fixate and focus and stress over that one position. They will ignore the fact that they're up $300,000 on the whole account, and they will instead allow one position that might be down $10,000 or $20,000 to overwhelm them and give them tremendous stress and anxiety. A person suffering from loss aversion cannot be happy with the big picture. Instead, they focus on the micro. They just lose their mind over a position in the portfolio that might be down. And this can become very challenging, both for a financial advisor and the client. I have had situations over the years where a client just cannot get past the fact that one position in the account might temporarily be down, and they just want to talk about it incessantly. They cannot let it go, and they can't be happy about the top line performance, the net return of the total account. Instead, they lose their minds and cause tremendous stress for themselves and often for their spouse as well, over maybe one position out of 20 or even 30 that happens to be down. If this is happening to you, recognize it and stop it. It's not healthy. It'll give you a lot of stress that's all unnecessary. Loss aversion can be very problematic when you have concentrated positions. If you have concentrated positions that are losing A person suffering from loss aversion typically will ride them lower and lower and lower, refusing to sell. At the same time, they may sell their winners early. So when you're dealing with loss aversion, it can really mess up your long-term performance by holding losers longer than you should and selling winners early. The last thing I'll say about loss aversion is just try to be happy with the big picture. If you're winning overall and your bottom line performance is really good, don't stress yourself out over one small position in your portfolio and let it drive you crazy. If you enjoy this content, please share it with your friends. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.